There are many approaches investors can take when building crude oil exposure into their portfolios. Two of those choices are futures contracts and exchange-traded funds or ETFs. If you are not already familiar with a futures contract or an ETF, please visit our other modules that cover these topics. Let's look at some of the attributes of both the Wti Futures Contract and the Wti ETF. One major reason why traders use these products is to gain access to physical markets like gold or oil. For example, in the crude oil market, managed money customers usually do not own assets or engage in the underlying physical market to trade, store, and deliver physical crude oil. Physical market participation requires significant infrastructure investment in oil production, storage tanks, and pipeline distribution facilities. The same challenge applies to other physical markets as well. To gain direct crude oil market exposure, investors can trade WTI futures contracts, which are physically delivered, light sweet crude oil from the Cushing, Oklahoma hub. The WTI futures contract is the international benchmark for crude oil prices, and increasingly so with U.S. production growth and the lift on the crude oil export ban. NYMEX WTI futures offer significantly more liquidity and efficiency compared to popular crude oil and energy index ETFs, plus a tighter tie to prices in the physical market. Oil ETFs offer easy market access and positions management. Some other advantages of futures over ETFs include: there are no management fees when you trade NYMEX WTI futures. The WTI futures market has roughly 24-hour trading access. When overnight market events occur that can impact oil prices, such as elections or weather, there's no waiting, unlike waiting for ETF to open. Many oil or energy ETFs use NYMEX WTI futures to provide oil market exposure, whereas trading NYMEX WTI futures gives you direct access. When NYMEX WTI futures roll approaches, oil ETFs often lose some of their correlation to the underlying market, which can inflate your costs due to slippage. The two popular crude oil ETFs are the United States Oil Fund, USO, and the United States 12-Month Oil Fund, USL. Both ETFs are issued by the United States Commodity Fund, LLC, but represent a different underlying futures exposure. The USO is designed to track the price movements of the WTI futures spot month contract. If the front month contract is within 2 weeks of expiration, the positions on the front month contract will be rolled over to the second front contract. USO has different WTI exposure than the WTI front month futures contract because of its rollover schedule. Since the USO rolls over its front month contract 2 weeks before it expires, it is in fact exposing approximately half of its price exposure to the second front month contract price. Historically, the USO performance deviates slightly from the WTI front month contracts. Even though the USO tries its best to mimic the front month WTI price, performance also deviates from WTI spot prices due to roll yield, transaction costs, and management fees. The USL is designed to track price movements of the rolling average of NYMEX's WTI futures 12-month forward contracts. The front month contract position is rolled over to the 12-month forward contracts, constantly maintaining an average price exposure of the rolling 12 consecutive months. We've discussed some of the features of both the WTI futures contract and the WTI ETF. Investors need to be aware of the differences between these products so they can decide what works best for them.